So it's my pleasure to introduce Andy Kelleher, my friend and a great professional, going to talk to us about helping us save our clients money utilizing estate planning techniques prior to that business transaction. Thank you, Andy.
My name is Andy Kelleher. I'm from Kelleher & Buckley Attorneys at Law. And any attorney talk wouldn't be fulfilled without a disclaimer. So this presentation we're putting on today is just for the purpose of illustration and discussion purposes. I'm going to try to fit in a lot of material in a very limited period of time. So hang in there with me if I speak relatively quickly, okay? We're going to talk about pre-sale planning for family business owners, and that's the topic for today. First of all, I want to say, Greg's got a hard act to follow. He's so eloquent, so I want to say thank you, MBBI, for having me today. I'm really honored to be here. I know there's a great group of very talented people, and hopefully some of the ideas that I'll be talking about today will help you help your clients achieve their goals. And I'm kind of focusing on the personal level goals today. Again, Kelleher & Buckley, we do have an estate planning group. We have 36 teammates, of which 16 are attorneys. And what's unique about us is that we evolved. The estate planning group was the core group, the start of our firm. But over the course of time, our business law group has grown tremendously, and it's evolved from our existing and evolving estate planning group. So we have a unique perspective, and we really like to focus on what we call the true bottom line to really help out the business owner, the seller, and their family. So today, if you take away a little new perspective, like I said, to help your clients out, that would be my goal for today. And when we're focusing on the seller and the seller's family, and we do pre-sale planning, and you demonstrate to that seller, to your client, that you truly have their best interests at heart, we've noticed over the course of our practice that if we focus on long-term relationships and really doing the right thing, and really focus on what is right and just, that usually will pan out for a long-term relationship with that client and will ease a deal. Because if you can establish some trust with that business owner up front, I think it's going to go a long way to make deals go a little smoother. And when you tell them to do something or give them some advice, maybe they're more likely to follow that. So consider that. And also, I don't think any of the methods today are it should enhance or delay any, so they should only enhance and not delay, otherwise adversely affect any part of the transaction. It's fundamental. I really do think it's going to help you out. Okay. And from an estate planning attorney's point of view, what's the frustration? Well, the first frustration that we see with business owners is that you see a lot of business owners who are working in their business. They're myopic. They're working on the day-to-day, month-to-month, how they're going to make payroll, they're just not working They're not working on their business. And it's a real pleasure, folks, when we see a business owner start to work on their business. And they work with an investment banker, they work with a consultant, they work with their CPA, they work with their attorneys. They're open to working and growing their business. But the frustration is that when they work on their business and they grow that value, many times we'll see if there's an untimely death, an untimely mental disability, there's some family infighting, a lawsuit pops up at the wrong time. All that work, all the income tax deductions we're trying to get, all the processes we're trying to put in place, many times we'll lose a lot of that value, and today we'll talk a little bit about one method of how we can avoid that. Across the board with estate planning, procrastination is the enemy. Sellers who wait to get their net sales proceeds check or their value, if they start planning at that point in time, they've lost, most of the situations, they've lost a significant amount of opportunity and value. We're trying to help them avoid that. I'm not going to be talking about maximizing sale value today. That's you guys, the investment bankers, the business brokers, and the consultants. You guys can help the clients out with that. We have our attorneys, we have our role in that, but fundamentally that's your deal. The other idea I just want to briefly mention, this is another frustrating thing that we see, and I think it's, especially in the current markets today as far as rates of return. A lot of business owners are thinking about selling their business, and they're making a good buck. They have good distributions from the company, they have good wages, they're getting deductible perks, and things are rolling really nicely. But they wish they would have sold, before the Great Recession, and a lot of people are kind of getting tired. But one thing you have to look at, you have to crunch the numbers with that client to make sure that they can afford to sell. You know, when they get their net proceeds and their net value, they don't have that wage, they don't have those deductible perks anymore. In today's environment, they just have to make sure that they have the cash flow to keep their lifestyle and make sure it really works at the end of the day. Okay, this is the main concept today. What are we focusing on? You know, this is just one solution and just one perspective. There's many out there, but I want to share this one with you. The idea is working backward and then forward to the seller's optimal wholesale end. And what does that mean? You know, the OPSE planning is to maximizing the seller's legal, economic, tax, and personal wholesale positioning. And it really is a perspective of what is that person's life going to look like the day after sale. So what do? You know, the first thing we have to be mindful of is the seller determines what they want. A good advisor shouldn't be telling a client what to do, at least from our philosophy. We should be illuminating paths, giving them options, and letting them decide, ask them questions, get their input, and really get to what that seller's optimal wholesale end means to them. But most of the time, you know, most sellers basically, they do what? They endeavor to deliver the net value that they receive from the sale to an asset-protected and estate planning-friendly environment. And they do that by combining and leveraging, maximizing the actual net proceeds themselves, which properly leveraging the estate tax exemptions and exclusions. So what are the steps? The 4 steps to OPSE planning steps are as follows. Step 1, discover what do you want? What does the client want that the day after closing to look like for them? Sit down and design that. Then once they figure out what they want at the end, work backwards. And step 2 is you want to analyze the current situation, determine what steps are necessary to get to that end, take action. And I can't tell you how many times we see business plans, estate plans, any type of plan. It's wonderful ideas, but they don't take action. Meetings, people meet. They don't have action steps after the meeting. It's just a bunch of ideas. So implementation is the key. And then finally, step 4 would be, let's achieve the end. Common components of OPS planning include never let the tax tail wag the dog, never let asset protection wag the dog, none of that. One of the most important things for clients, if not the most important thing, is after sale, they want to maintain possession of use of their asset. They want access to their money. They also want the other perks of asset protection and estate planning, but most of all, they want access to their money. Then another idea would be attaining the asset protection for the seller's spouse and children. These days, it's a really hot topic at our office. You know, clients basically are clamoring, we want more asset protection. They're worried about that. And at the end of the day, we want to give them some peace of mind. Lessening the impact of estate, gift, and GST taxes, obviously a major component of the planning. Other items would include looking at ways of setting up the plan so you can shift income to lower generations at lower brackets. I would like to see a little bit more of that planning happening. I don't see a lot. There's a lot of talk, but not a lot of implementation. And then strengthening the seller's financial position, and economic position. You know, in the process, it may be a good idea at some point in time to bring in the client's financial planner, their banker, and the like on the personal wealth side to make sure that their perspective is also included in the equation. And then the other personal seller desires. Questions. In order to formulate what the optimal wholesale end is, you have to ask questions, and the clients have to ask themselves questions. For example, what happens if the seller dies the day after sale? You know, the idea would be, who's going to be in charge of the financial affairs? What are the estate tax consequences? What happens if the seller dies during the course of the sale? You know, do we have a plan in place to make sure the deal stays together? You know, or do we have a plan in place to make sure the family doesn't lose the value? We've seen some transactions go over a very long period of time. It could be 6 months, a year, sometimes 2 years. But the idea would be, let's make sure that we have control. You know, the same thing goes for mental capacity. So I can go on and on with the questions, but the idea is it's important to ask those questions. So for purposes of today, I'm going to focus on the estate tax exposure and the asset protection because I only have about a half an hour. Greg promised me that if I go over, he's going to take the hook out and take me off the stage. So let's go into a case study for Joe and Mary Smith. Okay, Joe, I'm trying to keep it relatively typical. Joe and Mary in their 60s. Joe and Mary each own 50% of the common stock of their company, the family business JM Inc. As of today, JM Inc. is valued at about $10.86 million as determined by an appraiser. The operations and management of this company are just inefficient and severely depressing the value. This is a great target company for you guys to come in and maybe to purchase, but many times as an advisor, we're trying to help our client preserve their value. So we're going to make sure that we bring in somebody that's knowledgeable to help them with that. Next idea is that Joe and Mary also have non-family owned business assets that are significant of about $12 million or so, which would include cash, real estate, marketable securities, 401ks, and like their personal assets. Then secondarily, they're going to stay in Illinois indefinitely. They live a very moderate lifestyle. We deal with a lot of clients that sell their businesses for a lot, but then they don't really change their lifestyle all that much. And they don't have a charitable intent. I'm not going to go into that today because there's a lot of charitable planning that we were talking about before the presentation today, how important that can be. We're not talking about that. And also, Mary's a practicing physician, and they don't have a basic AB trust or revocable plan in place. So let's get into it. The case study scenario, number one, would be the sale process without OPSE planning. The good news, Joe and Mary are asking for help. Too often, again, we see clients working in their business, not on it. Big problem, but at least Joe and Mary are smart enough to get the help. That's the first step. They engage investment bankers, CPAs, attorneys to address the common issues affecting value. Diversifying customer base, establishing efficient business process, cultivating employees, and so on. But they do something. The bad news is there's no OPSE planning. They're kind of going through the process. They're building up value. They call it the balloon effect. They start building up value. They start working with people, with their advisors. Value grows, the value grows, the value grows. But at the end of the day, what's happening to that value? So let's get into it. So the case study scenario number one, this is without OPSE planning. I put it into a timeline. So the idea would be today, January 23rd, Friday, until February 14th. Joe and Mary first, they decided to sell the business. We saw that in the facts. There's the 100% of JM Inc. is valued at $10,860,000. Joe and Mary, again, they work with their advisors. They're smart enough to do that. And then the advisors do a great job. Many efficiencies are identified, and this business grows tremendously. So from the period of February 15th until the closing date, which would be in this case June of next year, June 1st, JM Inc., the value grows from $10.86 million to $20 million. Pretty. I'm trying to show you for illustrative purposes. This is a pretty good job. But the idea look at the red. During this period, Joe and Mary lose. And how have they lost? Well, the problem is if you take a look at the potted plant on the bottom, I think the picture helps. When they start the process, the potted plant is already in the default tax planning, estate planning zone. They haven't done any planning, so the default is they're going to get taxed. So what they do is they make a mistake. They work with the investment advisors, and that balloon, that value, that growth of that plant grows into the mighty oak to $20 million. But what happens? The next stage. Let's just say bad things happen to people. The idea would be the day after closing, our focus. What happens if Joe and Mary pass away? It happens. Well, they're going to unnecessarily pay a boatload of taxes. We're going to see that the savings of OPSE planning can be very significant. What happens if they get sued? Well, if they don't do any type of planning, you don't want those assets exposed. So let's start thinking ahead. Again, what should Joe and Mary consider? They should consider the 4 steps. Define what the OPSE, analyze the current situation, determine the action items, and implement. And then achieve. So here we go. Step 1, Joe and Mary define the OPSE we're talking today about estate tax and asset protection purposes. Also keep in mind there's other common issues that they would like to achieve. Obviously, they want the maximization of value. Like I said before, the reasonable access of use of money, income tax. They want an income tax neutral result in many situations. I'll be talking about grantor trust later. And also the ability to shift income to the lower generations at lower brackets. So what's one solution? There's many ways of skinning the cat. And this is just one common one that we see. So Joe and Mary, they sit down with the advisors, including the estate planning attorney at this point in time, and they decide that they want to use a spousal lifetime access trust. That's a trust where they can place the stock into a tax-free growth zone, okay? And also they want to implement pre-market valuation discount planning along with the business and growth planning. So I'm not sure, I'm going to get some hands here. How many people are familiar with valuation discount planning? Raise your hand. Okay, I'm going to go through it. There's a lot of people that didn't raise their hand. So the idea, here's the basic idea. On the entire 100% of JM Inc. is worth $10.86 million. Okay, at this for pre-market valuation discount planning is really a key point because there's no offers out there. There's no other indicia or evidence of what the value of this company is worth. So the family has a lot of flexibility to set the value, and they also work with the underlying value of the company, but they also have the ability to do discount planning. And how does that discount planning work? So 100% of JM Inc. is worth $10.86 million. The valuation expert would come in and say, Joe and Mary each own 50%. And they would value each of they value Joe's 50% separately from Mary's. And they would say, well, what's the value of that 50%? Well, normally the thought process would start with, well, we know what it's not worth. We know it's not worth 50% of $10.86 million. Why? Because the fair market value is determined by what a reasonable third party would pay for that 50%. And the person walking off the street is not going to pay $5,430,000, okay, for an asset they don't have control over, and they can't easily transfer to somebody else's marketability issues. So between the minority discounts and marketability discounts in this particular case, which is relatively conservative in my experience, is that the appraiser determines that there's a 30% discount that's appropriate for that minority and lack of marketability. So if you look at the numbers, and I'm not going to go into it too much farther, but when they value each of Joe and Mary's 50% interest respectively, the total value of that is $7,602,000. So the trick here is that once you get that discounted value, you want to leverage the estate tax exemptions that are available for Joe and Mary, and you want to take that discounted amount of the stock and transfer it into the slats, so that growth going into the future is in the estate tax-free zone. If you get that, if you followed me on that, and I'm going to be available for questions later. If you got that, then I've accomplished my goal. Once they go through and they analyze their situation, they look at the action steps, then Joe and Mary have to start implementing. They have to act. And then hopefully it's step 4, Joe and Mary achieve. Here we go, the case study number 2 with OPSE planning. So let's look at the results. Again, today until February 14th, Joe and Mary decided to sell. 100% of the company is still worth $10.86 million. The business advisors do a great job. They identify the inefficiencies. They act. They get the inefficiencies addressed, and the value dramatically increases. But in this scenario, they use the OPSE planning methods. So again, JM Inc. grows from February 15th until the closing date from $10.86 million to $20. They implement the SLAT planning. They create the estate tax-free zone. They implement pre-market valuation discount planning. They transfer those discounted assets into the estate planning growth zone. What's the bottom line result of that action, that thought process, that pre-planning? Well, the bottom line result is that you're going to get about $12.4 million worth of value outside of Joe and Mary's estate by the time the closing occurs. So you have the discounted amount going into the tax-free zone, and the entire growth of the $9.1 million is going to be in the tax-free zone. And that's not where it ends, because obviously there's a lot of value that's going to be growing into the future inside the SLAT structure. But what we're focusing on today is what happens the day after Joe and Mary pass away. What happens the day after closing if Joe and Mary were to pass away or get sued? So here we go. What happens? What if that happens? Well, they pay significantly less estate taxes with the OPSE planning. I'll give you some numbers in a minute. What happens if they get sued? Well, the entire $20 million is protected because this type of planning is third-party trust planning, which can be very powerful and provide excellent asset protection for our clients. I just want to give you an idea of the said slats are one method of doing the planning. And the other idea here I want to make sure that you guys are aware of, the Joe and Marys of the world, they don't have to transfer all the stock into SLAT planning. Many times we'll take a portion of the take a portion of the stock and put it into the slats. Sometimes we'll combine this planning with children's trusts, and there's other items, but I'm trying to, just for illustrative purposes, show you maybe some of the ideas and some of the power of the planning. So how does it normally work? So if Joe and Mary, over the course of time, between February 15th and the closing date of next year, they'll go through and they'll establish the slat structuring. Okay, it's not all done at once because there's reciprocal trust doctrine issues and things we have to work through. So timing, the finessing the timing is very important with this type of planning. But what they essentially do is Joe sets up a trust for Mary, and Mary sets up a trust for Joe. Joe gives his assets into that trust for Mary, and then eventually Mary would do the same thing for Joe. Once that stock is inside that trust, for the bottom line purposes of it's asset protected, it's in an income tax neutral zone, and very importantly, it's outside of the estate tax arena. And as a married couple, the way this is set up, Joe and Mary have access to their money and have those attributes. So this is using slat planning in the right dose with pre-market discount planning. Like I said, as a doctor would say, in the right dosage, it can be extremely powerful. Let's get down to some bottom line ideas. So comparing the scenario number one without the pre-sale planning to scenario number two with the planning, what's the bottom line? At the office, I'm constantly saying to the associates, I'm saying, focus, give me answers and focus on the bottom line and give me a solution. So I'll try to do that for you. So if we take a look at, this is the place I want to look at. The day after, if Joe and Mary were to pass away, the day after closing, the estate tax that we do would be about $10.4 million without the planning, and about $8.1 million with it. So literally, the day after closing with this planning, the family can save like $2.3 million in cash. That's not a bad deal. If they get sued, the assets are protected. The lawyers love that. We have a much better platform. We're going to be defending from high ground, fortified high ground, instead of being on the field totally exposed. Good solid planning. Now, if you take a look at going into the future for the family, because obviously life doesn't end the day after closing for many times, or most of the time. If the growth rate is only 5%, which I think is pretty conservative, over the next 5 years out, 10 years out, 15 years out, obviously the numbers, the estate planning increases. And just keep in mind, guys, this is pretty conservative. With an operating business, we got a 30% discount. That's pretty conservative from what we see out there. 5% over a 15-year period. I'm not an economist, but generally speaking, in the trust and estates land, that investments over a long period of time should be taking somewhere between 7 and 9%. We litigated that issue. That was the answer in a particular case, but that's generally pretty true over a long period of time. Obviously, we haven't felt that in the last 10 years or so. Same scenario as before, but let's just say there's a 10% growth rate over the course of time. And people say, wow, that's like, out there. 10% in the market right now, that's way too much. Yeah, it might be, depending on what they invest their money in. But we have deals where what? The seller participates with the buyer, right? They sell their stock maybe as part of the deal. They get purchaser stock. And many times that purchaser stock was the best in that person ever acquired, and they can get some excellent returns. So in many situations, depending on the size of the deal, the 10% return is not out of the question. So, but if it does happen, look at 5 years out, it's a $6 million difference in cash to that family. $11 million, $21 million. The numbers get relatively large relatively quickly. And this is something that people should be focusing on, and at least considering with their clients and doing the right thing. Lest we forget GST. It's really GSTT, Generational Transfer Skipping Tax. But the idea is that just in addition to the estate tax savings and the asset protection, there's also this GST thing out there, and a lot of people don't really know what it is. But the idea is the GST exemption is an exemption that we can allocate to the slats to allow the growth inside of that trust. Literally to stay estate tax free and asset protected over many generations. And in Illinois, which is interesting, which we don't hear a lot about our laws and our tax laws being all that great in Illinois. The one great thing about Illinois, we have the option to opt out of the rule against perpetuities, which in Illinois a trust can last forever. You know, most states it's going to be like Florida, it's 360 years, and in many states it's 90 years type of thing. But in Illinois, that's a pretty neat law that we have. So it can literally last forever. And if you do if we did a analysis on the savings on a multi-generational level in this deal, it's almost unbelievable. But in our experience, many clients, yeah, they worry about the generations. You know, some clients like the idea of having their picture on their wall with their hand in their vest. But many clients are really worried about making sure that my children, making sure that my grandchildren, you know, are protected, make sure they have a good trustee, make sure that they're not, you know, that protect the children from themselves and from their creditors and divorce, and all those wonderful attributes are built into this planning. Again, you know, for larger situations, Joe and Mary's situation was $10.86 million, and it grows to 20. Obviously, we all deal with situations that are a lot larger. And when there's situations that are a lot larger than that, the straight-up gifting method I talked about today in the examples isn't enough. So the key to it, most of the planning is well, how can we shift future appreciation down to the next generations in larger situations? And our office will use many different variations of the following planning mechanisms. You know, we use grantor retained annuity trusts, sales to intentionally effective grantor trusts. We do a lot of charitable planning. For people who have a charitable intent, you know, we can really help out to knock that tax bill down. And also other ideas like some income tax ideas of BEATITs and the like. And then some more simple things like interfamily loans, and then straight up family loan with liability company planning. If you have any, like I said, I've covered a lot of ground, and if you have any questions, feel free to call me. At the end, I put my cell phone out there. If you're a friend of Greg's or a friend of mine, I'll trust that you'll use your discretion in calling me. At the same time, I want to help. I really want to help people out. Like I said, we look for long-term relationships, and we care, and we want to do the right thing for our clients, and I know that you want the same. Yeah, to answer your question, on day one, like if they died the day after closing, the value is going to be the discount planning. That's going to be the driver of that value, that savings, okay? From that point on, it's going to be a combination of the discounted amount and future growth that's going to force the savings. And the difference, the spread, like the 2.1 million, the 2.3 in the first year, that's going to be the actual tax, the check that the family doesn't have to write. Because I'm just saying to you, again, the base frustration that we see you guys do a great job. You build up these businesses. I mean, you guys do a great job. You're invaluable to your clients, and we recognize that. At the end of the day, though, we don't want to see all that good work, go for naught. And that's just not the right thing to do. Of course, I mean, we're dealing with business owners, right? So, I mean, many times they're very controlling people. Some people would even go as far as say sometimes, forgive the terminology, but a little bit narcissistic. But the idea is those type of qualities have driven that person to achieve. They're very goal-minded people. They're very driven, and we deal with a lot of situations where we have to slowly bring up these ideas to just the quote-unquote the controlling, the father who's paternalistic in many cases, to slowly try to get them to show them the value, reduce things down to logic and numbers, and get away from emotion and control, and slowly over the course of time try to show them to give up control. And many times we succeed. Sometimes we fail, because you're never going to be able to get past that sometimes, that emotional barrier of not letting go. At the same time, if we're savvy about how we structure things between voting units, non-voting units, voting stock, non-voting stock, and using trust properly, where maybe, because part of the discount planning is like father giving up control, right? So one little tidbit would be, well, maybe we take half the voting units, right, and put it into a trust. Maybe for the benefit, a little separate trust just for Mary's benefit, but we give Dad the power to appoint and remove the trustees. Maybe he feels a little bit better about that. So you try to come up with a solution, but sometimes we fail, right? It's not always perfect, and sometimes it's that person's will and a sense of or desire for control is insurmountable. You can lead a horse to water, but you can't make him drink. Okay, as far as the taxation of this, these things are set up as long as Joe and Mary are alive. These are grantor trusts, so the income taxation of this would be relatively neutral. Okay, you want to make sure there's some capital gains provisions you want to put in the trust to make sure the capital gains issues are addressed if somebody were to pass away and the like. But generally speaking, there's really little, very little to no impact from an income tax perspective. As far as the reps and warranties, as far as control, the reps and warranties, there can be issues there because the reps and warranties would be made by the trustee, but we have to get around that.
Transfer prior to sale is a very common